Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, thank you again for having me.
Tim, was this actually the month where sell in May and go away would have worked? Would it have worked this year?
Well, we may be setting up for that sort of thing. Equities, I think, are moving according to, the cycles that I see. I think equities are moving into, in my world, what I would term an intermediate degree low coming up, ideally in June. So I think that the pressure should still be on equities to move into those lows. And then as we move, through the next few months, I think we're going to see the setup to where either we see a reinflation of the bubble or it dies. And I don't think there's much in between. I've been saying in my letter and laying it out as to why, but inflate or die. And I think that's where we are with the market. So as we move in, to the next couple of months coming out of this, coincidentally, that the sell in May, go away thing, we are at a risky juncture. And, I think we're about to see some indication as to which way this sets up for. And to put that kind of in perspective, as far as how it relates, we've talked about the big picture, the last interview or two, but the battle here is, to kind of put this in perspective, is that we're seeing in my world, based on some economic data, raw materials data, and so forth, some materials that I have and track, we're seeing a rollover out of, or it's trying to turn over out of the sixth long-term economic cycle since 1800. And I'll give you some numbers with that. The first economic cycle that I'm looking at, we saw commodity raw material prices in 1840. 1840s turned down 59%. The corresponding move in stocks was 77%. The next cycle turned down into the 1890s. We saw an 80% decline in commodities, 50% decline in stocks. 1933 was 32 bottom in equities. 33 in the commodity prices. We saw a 75% decline, 89% decline in stocks. In the 50s, 60s, we saw a 21% decline in commodity prices, and the corresponding low was 43% in stocks. And that was at the 70. That low occurred in equities a little bit after the commodity low. That was the 74 low. They were a little bit out of sync there. And then this last cycle bottomed in 2001, 2002, and we saw a 38% decline in the commodity prices and a 39% decline in stocks. So that said, from those lows, we started a new cycle. We started that new long-term cycle, the sixth cycle up. And if you think about it, the entire cycle has been built on monetary policy, not an expanding economy. And now we're seeing signs that it's trying to roll. And look at, when I say signs, look where the bubble is now. It's primarily in equity prices, and has been this entire advance. We haven't seen, commodities peaked way back in 2008. Some things made a higher high in 2011, but since 2008/11, commodity prices have been down. Everything didn't move up together like it did into 07, 08. So now we're seeing, you look at some of the agricultural commodities and so forth. I mean, more recently we've seen a little bit of a bounce in some of the specific commodities, but they have been beaten. And in general, the raw materials is down. Some of the industrial metals have moved lower for the year, and so we're seeing evidence, hard evidence that this thing is trying to turn. And so that's why I'm saying, equities have been, last year we talked about how the setup for the top equities were masking it, or they were camouflaging what was going on, or the U.S. markets were. And we're seeing the same thing here. It's keeping everybody happy, everybody asleep, nobody sees the danger. And literally we're moving into a technical, cyclical juncture where it has to either reinflate. And when I say reinflate, the reinflation of the bubble, the can has to be kicked down the road. This thing has to expand, or I think by default it dies. And I think that's where we are as we move out of May into the next few months.
Are there any safe havens to go into in the meantime? Utilities, things like that?
I think utilities are ultimately in the process of peaking as well. I haven't done a study where I can quantify it. Sometimes, just in general terms, utilities will tend to be one of the holdouts as well. But once a turn happens, it's going to affect pretty much everything, all asset classes. I'm thinking, it's just a mammoth process. It's like an explosion in slow motion, if you will. And, it all has to set up. The safe haven, equities, they'll decline a little bit like we saw in December, and then they'll bounce back, and then they decline, and they bounce back. But if you look at a chart, they haven't gone anywhere. And I think that's part of what has built the level of complacency into the market that we see. I was talking to a guy yesterday. I haven't looked at the data myself, but he was talking how there's record shorts. Record lack of shorts in the market right now. And, people are afraid to even short the market. And that in and of itself, shorts and people being short in the market is a source of fuel. You can force those people to cover, and then the market, it's fuel for the market to rally. And we don't even have that. And I get it. Because the market has been so resilient, it's gone through this process of setting up with this longer term top that it's just created enormous complacency is my point. And as far as safety, I know everybody wants to point to gold and so on and so forth, but we've said the 9-year cycle top is in place in gold. Gold hasn't gone anywhere. It's off a little bit. We're seeing a little bit of a counter-trend bounce now, but I do think that gold ultimately continues to drift lower. Once this gets traction, or if it gets traction, like I said, the test is at hand, I think, in the next few months. But I think ultimately gold goes lower. And I maintain that the dollar. We talked about that probably 18 months ago now, early 2017 or 18, and I still think the safe haven is, if there is one, is just to be out of the way once it goes.
We'll have more with Tim Cycles Van Wood right after this.
Hey, since we're on break, can I walk over and get my contact? I rubbed my contact out of my eye. Let me go. I got a mirror in here. I just need to walk over to it and get my contact out.
Yeah, okay. Sure.
Okay.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's happening in the bond market?
I've been saying that I think that interest rates move lower, which means bond prices move higher. And that's exactly what we have been seeing. And I think that that will be the trend for the foreseeable future. I mean, ultimately, I think there is going to be a massive top in the bond market as well, but not yet. I think that as this market starts to crack and interest rates go down, which they naturally are, I mean, we're seeing that, especially here in the last week or so. We've seen bond prices moving up sharply. And I think that's the market is going to force the Fed into cutting. And once they start to cut, I think that is perceived as a positive for the market, but I don't think that's going to prove to be the case this time, for reasons that I've covered, in the letter. I think that's going to be the death knell, and it's a sign of the problem. It's not a solution to the cure.
I was going to ask, have lowering interest rates ever prevented a recession? The Fed's done it 18 times, and 18 times there's been recessions. Would it be any different this time?
I don't think so. And if you look at, it's kind of comical in a way. If you look at, and I don't have the data in front of me, I have a spreadsheet going back into the 40s of every rate cut and hike, back into the 40s. I start saying history, but going back into I think it's 43. But anyway, I've studied that. I don't have it in front of me. But if you look like you go back to 2000 and you look at, I don't remember where we were, 7.5, 7.25, it seems like. And they started cutting. And it didn't stop anything. I mean, the market did what it did. And they started cutting, near the top. If you look in 2007, 8, I think the first cut, and I'm saying this from fuzzy memory, but I think the first cut was in August, as I recall, before the market, it didn't top until October. And, the bond market forced them to start cutting. And did it stop anything? No, it really didn't. And I think we're going to see the same thing here. I think that we're seeing bond prices, short and long, moving up. Rates are moving down. It's going to force the cutting, and I think that's a sign of the times, just like then. And it's going to be perceived as, like I said, a good thing, but it's not. And to your point, didn't really change anything in 2000, and it really didn't change anything in 2007 and 8 and into 9. If you look at the data, the perception is that it did, but it didn't.
Should they keep the rates the same or even boost them in troubled times?
No, because they follow. That's another misconception. I mean, it's almost like what comes first, the chicken or the egg. I mean, I understand, and so does everyone. I mean, they can control short-term interest rates by raising and lowering the discount rate and the Fed funds rate and so forth. But if you look at the data in a spreadsheet like I have, and you line up the two columns and you analyze simply what the short-term 90-day T-bill rate is and the corresponding, say, the discount rate, what you find is that the Fed follows the 90-day T-bill rate, and few people understand that. So they actually follow the market, and what I'm saying is that the market is going to force them to start to cut. It's coming.
We'll have more with Tim Cyclesman Wood right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's your outlook for crude?
Lower. Some of the leading economic data that I follow, it is uncanny how, some of the stuff, I don't know how to say this. It not tracks crude. It's more like crude tracks it. And, it's a leading indicator that I have. And it has clearly turned, ahead of crude in, at every major turn. The only question is how much lead time, and that's, I don't know. Each time is a little different, but the fact that the turn has occurred tells you what is to follow with crude. And we have seen a softening of crude. I think it's in the process of like equities of making the turn. And I think lower prices are going to follow in crude oil, no question.
We talked briefly about gold. So many people say if the markets go down, gold's a great place to be. Is it?
That's another misconception. And a perfect example is 2008. I say 2008. 2008 is another perfect example. No, I think everything is going to go down together. The 9-year cycle top is in, and gold is going to drift lower with the rest of the commodities, like it or not.
Mm-hmm. Now, we've had major flooding in the U.S. Midwest. They haven't been able to plant their crops. Will that lead to higher food and agricultural commodities?
There may be a pop in agricultural commodities, and that may be what we are seeing, the more recent short-term, advances in some of the commodities, agricultural-related commodities, maybe because of that's what I'm trying to say. But overall, the pressures on commodities, no question about it.
Tim, anything else we should be taking a look at right now?
No, that's pretty much it. I know that to many it sounds like, I don't know how to even say it, like doomsday stuff or whatever, but the problem is it's gone on for so long. Like I said, it's created enormous complacency. And they're not going to come out. I say they, and who's they? Well, if you read, for example, back in the late 20s into the 30s, they were the powers that be at the time, be it the economists, the media, the politicians, whoever. You've heard the quotes, we've never been, at a permanent plateau and, everything is okay and so on and so forth. And so they didn't warn the public back then. They never are going to tell the public the truth about what's really going on because they can't. And it's the same thing here today. Of course, before he was elected, Trump talked about the bubble. Now that he's elected, everything's great because of him. But, the bubble is still here. It's worse than ever. They've done a magnificent job at containing it. And they aren't going to tell people about it. They're going to continue to feed them the line, and everybody's going to think everything's okay until it's too late. And then they are going to be pissed off because they weren't told or warned when there's, people out there like myself that see this for what it is. And, it's been somewhat frustrating seeing it setting up and understand what's going on. And people just don't get it. And, it's not a matter of opinion. It's a matter of fact. It's backed up by data. And so that said, I talked about the sixth economic cycle. Get some research. Look at it. one time I was at a convention. I was speaking at the New Orleans, I forget what it's called, Investors Conference, whatever, back in 2000, I don't remember when it was, 7 or 8. It was 2000, I know exactly when it was 2007. Because, it was in October of 2007, the month the market topped. And I gave a PowerPoint presentation showing what was happening. Just like I've got like in the May letter right now, showing exactly where we were cyclically in the whole thing. And I remember, I guess, I felt like it fell on deaf ears because people can only see what they can see. But I was getting in the elevator, and this lady, we were talking about the 2000 top, and this lady made the comment, and she said, man, I wish I'd have known about you then. I wish I'd have had your research then, and because she got caught in that, and she said it would have sure been nice to have had that then, and I'm thinking to myself, no, it wouldn't. You wouldn't have listened. You wouldn't have listened. It's just like now. It's just like now. No one's listening, and so it is what it is. My point is that people are people, and it's the same cycle there. People think everything's fine. But I'm telling you, get some research. Look at what's really going on. And I understand that this has taken forever to set up. I can't control that, neither can anyone else, but it doesn't negate or change the fact that this is a ginormous bubble where we're at, and that we are seeing a rollover out of the sixth economic bubble since 1800, or the sixth economic cycle since 1800. And it all boils down to how well they can contain it, how much longer they can keep it together before it just, overwhelms them and comes apart. And it will happen. It will happen. That I can promise. It's just a matter of monitoring the data and then seeing it come together.
Tim, thank you so much for being on the show.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.